Recording in progress.
Good morning. Alan Tewuho Busle. Do we form a quorum?
Good morning, Chair. Yes, there's currently 6 members on the platform.
Yeah. Okay. Let's start with our meeting. Where are we? The meeting is officially opened, and let me welcome the members of the Standing Committee Finance. Welcome the support team, all other entities of Parliament that support committees. Welcome the public who are in attendance, welcome the media and everybody. Let's move to apologies. Do we have apologies?
No apologies received, Chair.
No apologies. Then let's move to item 2, briefing by National Treasury and SARS on the draft 2024 tax bills. covering the following: 2024 Draft Taxation Laws Amendment Bill, TLAB, RLAB, TALAB, and the draft rates and monetary amounts and amendment of revenue laws bill, draft rates bill, the 2024 draft global minimum tax bill, the 2024 draft global minimum tax administration bill. Over to you, Treasurer and SARS. You will check us through all those bills, then we'll come back at number 3 when we deal with questions and comments by the members.
Okay, thank you very much, Honourable Chair. Good morning, Honourable members. So I'm Chris, Acting DDG for Tax and Financial Sector Policy. I've got my colleagues Warren and Schleinsler here that I think were with you last week, as well as all their team members, so they'd be able to answer any of the detailed questions on the bills. SARS will also join us. And Schleinsler has prepared a presentation and he can go through. And Schleinsler, would you like to share the slides and then start going through the bills? Thank you.
Okay. Thank you, Chris, and good morning, honorable members, and good morning, Chair. Basically, we're just going to start in slide 1. Slide 1 just basically, Chair, highlights what you just mentioned at the moment, that we're just going through all the 6 tax bills for today. And then maybe let's go to slide 2. The slide 2, basically, Chair, just, and honorable members, just talks through the process, the entire process of where we're at the moment. The 2024 rates and monetary amounts, the rates bill, it states that it was actually published on the 21st of Feb, and then we had the public workshops on the 6th and 7th of June. But basically, the rates bill, Paul will come in and talk more in detail on that one. Okay, the next slide, Arno. Okay, then this one, the 2024 Revenue Laws Amendment Bill, this one. Okay. The 2024 Revenue Laws Amendment Bill, basically this one we also published in terms of the process.
Chair, we can't hear the presenter.
It looks as if we've lost in Schleinsler. I'll perhaps try and go through these bills before Schleinsler gets back. So on this slide, honourable members, we were just talking about the different bills. A lot of these bills were published on budget day, and a lot of the content of the bills was announced by the Minister on budget day in February. So, for example, this Revenue Laws Amendment Bill was also published on the day of the budget on 21 February. That tried to deal with some of the final amendments for the two-part system. A draft Global Minimum Tax Bill and Global Minimum Tax Administration Bill were also published on budget. There are then more complicated tax measures that were announced in Annexure C of the budget. These will take a little bit more time to draft, as well as have consultations with industry to get the final structure. Those quite lengthy bills are the Taxation Laws Amendment Bill and the TALAB, the Tax Administration Laws Amendment Bill. Those are only published later on in the year. This year they were published on 1 August, and then public workshops were held on 12th and 13th of September, and they have much more technical and lengthy amendments to the tax system. Next slide. So as I'm sure the committee and the honourable members would know, there are two types of bills. We've got the Section 77 bills, which are the money bills, and the Section 75 bills. The Section 75 bills are the administration bills, such as the TALAB and the Global Minimum Tax Administration Bill. The money bills have a particular process, which we take through these committees. Normally, we have these public hearings on these tax bills before they are formally tabled in Parliament, which is slightly different to the way other bills are dealt with. Because of the long consultation periods that we need and the difficulty of these types of amendments, we need lots of consultation on them. So the committees normally have public hearings, and then there'll be public hearings within this committee next week. And then we will come back to the committee with our response document to say we've listened to the commentators, we've tried to perhaps make adjustments in the bills in particular areas or not. And then generally the bills are then only tabled by the Minister of Finance at the MTBPS. Next slide. Okay, the rates bill. The rates bill generally includes announcements that were made in Chapter 4. So it's, as the name implies, there's changes in rates such as tobacco, excise, the personal income tax tables. Umpo, would you like to go through some of these slides, given a lot of them are related to you?
Thank you, Chris. Good morning, Honorable Chair, and good morning, honorable members. In terms of the draft rates bill, it contains just about 3 sections. The first section of the draft rates bill deals with the increases to excise on alcohol and tobacco that were announced in the budget, and the second one deals with the adjustment to the carbon tax that was also announced in the budget in February, and the last one deals with the adjustments to the diesel component of the or the liquid fuel sector component of the carbon tax. When it comes to the increases on alcohol, the minister announced an increase of between 6.7% and 7.2% on alcoholic beverages. And with regards to tobacco excise duties, the minister announced a 4.7% increase on cigarettes and cigarette tobacco, and an 8.2% increase on pipe tobacco and cigars. And also the minister announced an inflationary adjustment to the electronic nicotine and non-nicotine delivery system, normally or colloquially known as vaping. The minister made an adjustment to the duty on it in line with expected inflation. Thank you very much, Chris.
Thanks, Umpo. I think Nhlanhla is back. So Nhlanhla, do you want to keep trying to steer?
Okay. No, thank you, Chris. On the next one.
Did we lose him again? Is it just me? No, I don't think so. Apologies, honorable members, he's in the office and the Wi-Fi is not great. Maybe I will just continue then with the next slide. So the next slide is the Revenue Laws Amendment Bill, which relates to the two-part system. So there were a couple of amendments required to try and simplify and streamline the process for the implementation of the two-parts bill. Who do we have here to talk to it? I'm not sure if Zalasile, are you here? Yes.
Hi, Chris. Yes, I'm here.
Would you like to go through just the amendments in the bill? Thanks.
Oh, yes. Can I have the next slide, please? Good morning, Chair, and good morning, members, honorable members. Yes, on the two-pot system, we have introduced that the tax directives that you would normally require are not requested from the funds who will be paying out the withdrawals, especially for the transfers that would be happening between the component themselves. But when it comes to the savings withdrawal itself, after the money has been transferred from the vested pot to the savings component, then a tax directive will be required. That is the only way SARS can actually know and advise on the amount of tax that needs to be paid. What was also done is on the ceiling, as I've said, that between the pots themselves, any transfers that are happening intra-fund would not carry a tax directive requirement, so that we simplify the administration process. Thank you, Chair.
Thanks, Talasile. I think you are back through Arno's laptop, is that right?
Yes, I know it's.
Yes, Chris. No, thank you so much, and apologies, Chair, for the hiccup. I'm sure that my colleague did Zalisile touch on the two-pot retirement system. We did highlight it last week when we had the meeting briefly, that we're focusing on it was likely to ensure that there is some sort of a speedy implementation of this two-pot retirement system, and in making sure that, in the event that we don't need any tax directive going forward. And then the next slide will be on, so trying to do the slides now. The next slide was after we had the workshop on the 6th of June, we then had the comments that were received. So the comments, this now reflects some of the changes that were there, to say that one of the comments that we received, there was some issue, because generally there is a section 37D of the Pension Funds Act that says what deduction a member is supposed, that are allowed for the member. So the key issue then there was that we needed to clarify, because now we've got these three components going forward, how are these deductions going to happen? I think that was one of the comments. We tried to take care of that one. And then the other comment that we received was on the fact that I think around 2021, we had that formal immigration rule. So that if you are no longer a South African tax resident, you have to access your pension after 3 years. So there was some sort of a clarification there that needed to be made. And as well, the last one was more on the members who are over 55, as to say, when can they elect? I think if they want to contribute to the savings and the retirement components. That was just one of the issues. And then now when we come to the 2024 TLAB, the 2024 TLAB, because it's based on the number of provisions, we have the individual taxes first. Then I'm going to ask Zalisile to talk through one of the amendments that we made in the TLAB in relation to the employment tax incentive scheme. Zalisile. But I'm not quite sure what then happened there. But the key issue here, Chair, if you recall last week, one of the issues that we've mentioned, we did say that what we have seen currently was that there are some of those aggressive tax schemes that necessarily doesn't relate to giving the young youth some sort of incentive. And then we're aiming at those schemes currently, trying to target them to make sure that they are not going for, this norm, which seems to have happened now in the industry, we're trying to stop it. That is why we came up with some of the punitive measures in this current tax legislation. think that was the main one here on the employment tax incentive. And then one of the other one now, I'm actually also going to ask now my colleague Arno to touch on it, was on the next slide. This is coming up on section 7C.
Thank you, Grebe. Morning, Honourable Chair and Honourable Members. So at issue here is the amendments to Section 7 Cap C. Essentially, it relates to those very specific instance where there's a difference between the arm's length rate and the official rate, official interest rate. In those instances where the arm's length interest rate is lower than the official rate, there's been uncertainty by taxpayers as to how to deal with that and the interaction between Section 7 Cap C and Section 31. This proposed amendment just clarifies up to which point the two sections interact and which one would apply in what instance. More of a more technical correction to assist taxpayers. We're just switching chairs again.
Okay. And then on the general business tax, we're just going to touch on one of the few ones. This one, Chair, we did mention it as well last year, that what seems to have happened, we made an amendment last year where because currently in the Income Tax Act, you cannot carry forward the losses. So what we then said, we can carry forward the losses, but it was indefinite. So then what we made some changes last year was to cap it to limit it to 80%. So you can only carry forward the 80% and then not the full one. However, then the key question that came up is one of the taxpayers' workshop was to say, sometimes there are certain companies that are actually going through, that are winding up or that are actually in the process of liquidation. So we need to cater for those companies. And I think then, because then in any event, those companies should not be 20% rule, so to say. So we are trying to assist as well in this scenario with this amendment that we made here. And then I'm also going to touch on the other amendment, Chair, because there's so many amendments. This one, I'm just going to touch on some on the impact of IFRS 17 on the taxation of short-term, on the taxation of insurers. This one, in any case, Chair and honorable members, covers both. It covers the short-term insurance companies and the long-term insurance companies. Because what happened was in around 2015, we made changes to the Income Tax Act to make sure that we are aligned with accounting standards, so that we are able to see from the tax perspective what is being reported to the shareholders and also then tax that amount. So, however, because of the changes in the accounting standards over the years, we then have to cater for those changes as well in the Income Tax Act. And in this instance as well, it was one of those amendments, because then the accounting then changed and introduced this called IFRS 17, which was replacing this old one, IFRS 4. And then now the amendment that we actually made now was to cater for those changes, because now there are instances where it now affects the tax calculation. Basically, that was what we were trying to do. And then I'm also going to just jump over now, jump over to the international tax. And then I'm just gonna not talk to all of them, but I'm just gonna mention some. This one, Chair, basically this issue on refining the definition of an exchange item. This one, I think it's much better if I make an example. And honorable members here, we are looking at a scenario where you have a foreign entity and a South African entity. They make some sort of an agreement where in one end, it's called cross-currency swap. So in this scenario, you have, let's say, a South African entity paying an interest in USD to that foreign entity, and that foreign entity as well is paying the South African interests this side. However, the issue that happened was that in this structure, there was also a preference share that was issued. So now if we're looking into our own income tax, we then realize that there is some issue here because we are able to tax the exchange gains and losses between the interest that is paid by South African to that foreign entity. And then, however, and we also can be able to account for the other leg. However, we are not able to account for the preference share that is issued by the foreign entity to the South African. So here we're trying to close the loophole. It's much more of an provision. Then I'm going to go through to the tax incentive, and then I'm going to ask my colleague Warren to talk through the electric hydrogen powered vehicles incentive. Warren?
Good morning, Chair and honorable members. So as part of the fiscal package to support the transition of the automotive industry from mainly producing internal combustion engine vehicles for export, the National Treasury has been working with the Department of Trade, Industry and Competition to implement the DTIC's electric vehicles white paper of 2023. The main issue there was that some of Africa's key export markets like the EU and the UK have announced the intention to ban the sale of ICE vehicles into their jurisdictions by 2035 to ensure that we don't lose out on key export markets like that. The objective was to encourage investment in local production of these electric and hydrogen-powered vehicles in South Africa. And in the 2024 budget, government proposed to introduce a 150% allowance, targeting new investments in the production of electric and hydrogen-powered vehicles. So motor vehicle manufacturers will be allowed to a 150% qualifying investment spending on the production capacity of these electric and hydrogen-powered vehicles in the first year which they bring these assets into use. So this is a temporary incentive that would start from 2026, and it's allowed for 10 years in terms of the tax code. Thank you, Honorable Chair.
Okay, thank you, Warren. And then, Chair, we're going to move to the value-added tax. And then I'm actually going to ask my colleague Anissa to come in here to also give us a brief summary of what we did. Over to you, Anissa.
Good morning, everyone. Hope you can hear me.
Yes, Anissa, yes.
Okay, great. Okay, so in terms of the VAT, there were several proposals that we are making at this point in time. The one has to do with a past amendment that we made, and it had unintended consequences. So providing the VAT relief for non-resident suppliers of, sorry, I was talking to the slide you were on, yes, parts of ships, aircraft, or rolling stock. And the amendment we made there was to remove certain suppliers from the VAT net, and it then caused an unintended consequence of them having to declare output tax on all of their current stock. And so we were simply easing the amendment on this one. You can move on to the next slide. I won't go through all of them, I think, in the interest of time. I can just quickly rush through a few of them. You can go through the next one. Okay, this one, the foreign donor funded project regime. Now, this is a very sensitive topic because this is something that requires as much assistance as possible. There's foreign donors that then provide assistance to the country, either in the form of technical assistance or in the form of, financing arrangements. And what happens here is that the projects are given to sometimes universities or other implementing agents to implement. And it is very important that every cent of that foreign donor funding is used in that project. So we try to give VAT relief where possible by allowing them to register for VAT, even though they are not making taxable supplies. And then by registering, they are able to then claim input tax credits for all the VAT that they incur when they have to pay out. And that then ensures the money goes back into the project. So what had happened here was that there were a lot of implementing difficulties. If you look at a university, for example, a university is a VAT vendor and it makes its own supplies. But at the same time, it has, some universities have up to 200 different projects that they've got to implement. So from a SARS point of view, it's essential to be able to audit these separately, to be able to keep these accounting records separately, but also from the project's point of view, it's very important to keep these records separately. So the difficulty came in with now, how do you monitor your own returns and 200 others where you are supposed to ensure that the accounting records are kept separately, but you must also do separate VAT returns. And this is the amendment that we are proposing now, to make this as simple, as easy to implement, but at the same time, easy to see the difference between the different VAT vendors, the main vendor of being the university and the different projects at the same time. Okay, next slide. Next one. Next one. Yeah, this one. Okay, so this one has to do with educational institutions. Now, this would refer to, basic, higher, as well as, public, private, all of this in one. The difficulty with having the VAT law as it is that it has one rule for all. And the rule is obviously to exempt educational services, but at the same time, there was always the intention to ensure that if there were any taxable supplies being made that were in competition with private sector, that you would subject that to VAT. And that ended up with universities, for example, now being registered for VAT because they were making mixed supplies, exempt and taxable. But it assists in that respect, because exempt for VAT is not the same as exempt for income tax. Because for VAT, when you are exempt and only exempt, the problem is running your business becomes more expensive, because when you have to pay suppliers VAT, you can't claim that back. So it's actually beneficial to be partially taxable or completely taxable, because then either a part of the expenses you incur or all of the VAT on all of the expenses you incur, you can claim it back as input tax credit, and it eases your cash flow burden. Now, the way the wording is at the moment causes a lot of difficulty and confusion when it comes to supplies made to third parties, to outsiders. For example, they lease out the gymnasium, they lease out a hall, or even when the university is on break, they lease out the student residence. Now that can be seen as commercial accommodation equivalent to a hotel or an Airbnb or something of that sort. So the law, the way it's written, the wording is not clear on how to treat that for VAT purposes, and we are suggesting that we make this clear, but at the same time, we don't want to add unnecessary burdens to schools, for example, who might not have those expenses and don't want to fall within the VAT net, because submitting VAT returns and complying is going to be costly. I think those are the two main things for the VAT ones. The rest are in the slides. I'm happy to answer if anybody, any of the honourable members has questions on that. Thank you.
Okay, thank you, Anissa. The next one, Chair and honourable members, amendment that was made in the 2024 TLAB was on carbon tax, and I will ask my colleague Kuhle to take us through some of the comments. Thank you.
Good morning to the members and to the colleagues on the call. Thank you, Ntantla. So with regards to the amendments that were made related to the carbon tax, the first one is related to Table 1 in Schedule 1 of the Carbon Tax Act, which is aligned to the greenhouse gas methodological guidelines of the DFFE that set out the emission factors and the net calorific values for emissions calculations. The tables in Schedule 1, since they're aligned with the guidelines and the guidelines have been amended and updated, the proposal is to update the tables to align with the DFFE guidelines in order to ensure that there is alignment in terms of calculation of emissions for the purposes of the carbon tax. So this amendment is relation to emission factors, net calorific values, as well as the addition of new fuel types. Next slide, please, Ntantla. The next slide refers to the fugitive emissions table. This is also the same case in terms of Table 2 of Schedule 1, which is also aligned with the DFFE methodological guidelines. And there have been additional activities that have been added by the DFFE in terms of fugitive emissions calculations. And so the proposal from the Carbon Tax Act and the TLAB is to amend Table 2 to include these new activities and emission sources to the Carbon Tax Act to reflect the amendments that have been made to the methodological guidelines to align the two legislations. Thank you, Nhlanhla. Next slide. The next slide is with regards to the renewable energy premium deduction, and this is a technical amendment, and this is in relation to the unbundling of Eskom into different entities, and therefore it is to clarify the use of the renewable energy premium that in terms of electricity generators such as Eskom, that they may continue to claim the renewable energy premium that is ceded to the new entity, which is the NTCSA, or the National Transmission Company of South Africa. Thank you, Nhlanhla.
Thank you, Kuhle. Then the next slides are actually on the 2024 TLAB, the Customs and Excise Act, and then I will ask my colleagues from SARS, France, to take us through. Thank you.
Thank you. Good morning, Honourable Chair and Honourable Members. Move on to the next slide. All right, so this is a very unusual situation. It occurs, if I look back at history, once every 20 years or so. And this is where there is an amendment that is proposed that was not part of the budget. Now, this normally is something that happens in pretty extraordinary cases. If there's something that is a threat to the tax system, or perhaps something like the COVID pandemic, which would then necessitate interventions that happen outside of the normal budget process. This is one of them. So just to give a little bit of background, South Africa is part of an international organization, the World Customs Organization, and it has a standardized set of tariffs so that as goods move across borders, a standardized system is used and there isn't confusion about how goods are classified. Going back to 2002, there was a change which South Africa duly implemented. And one of the aspects of this change was a particular note that was added in the oils and preparations section of this tariff book. And this new note is given on the slide there. And the key point to note there is that we talk about products that are distilled at 210 degrees Celsius. Now, moving on, there are what are known as additional notes, and they then give you the specific treatment for certain kinds of products. And there you will see there is a different distillation below or at 362 degrees centigrade. And so you can immediately see, and hindsight is 20/20 vision, that there is a conflict. But for more than 20 years now, people have looked at the specific provision and they've said, okay, that's what we'll be using. And so goods have been classified on that basis and duties have been paid on that basis. Next slide, please. Now, what's since happened, and just as a bit of background, that interpretation is based on the idea that in law, generally the specific overrides the general. But there is a nuance that in the customs world, there's an argument that the additional notes override, the subheading notes override the additional notes. And so now you have a situation where someone has come to us and said, right, we'd like a refund of the duties that we paid over to you so that we essentially get the benefit of that which we've charged our customers, but we'd like it back from government, please. And so we've looked at that very carefully, and that's a relatively recent development. And that just gives you an absurd result. I mean, it flies in the face of everything that's been done up to date by the industry, and it flies in the face of common sense. So the suggestion is that we retrospectively correct this and then create a separate set of tariff headings, which essentially are duplicates of the ones that live under this particular subheading elsewhere. And that will then ensure that if it doesn't get classified under the one set of headings, it is classified under the other. And that means that we maintain the status quo. And just to create certainty, make sure that we recognize the fact that this is a long-standing practice, the proposal is that it goes back to the 1st of January 2002, which is when the original subheading note was inserted. Now, the immediate question may well be, well, is this kind of retrospective legislation problematic constitutionally? We don't think so. There have been cases in the past where this has been looked at, and the weight of case law to date is that that is an acceptable step to take under these kinds of circumstances. I would add that you will find this also happening in other jurisdictions around the world, which is where if an accepted interpretation is overturned or there's a possibility of it being overturned, clarity is restored retrospectively. And I think that's it for this one, and I'll hand back to Nhlanhla.
Okay, thank you, Franz. Let me just see the next one. The next one, Franz, is still the 2024 Draft Tax Administration Laws Amendment Bill.
I'm allowing you to be the MC. So moving on to the next slide.
Oh, gosh. Okay.
This is a relatively simple one. There's the ability to extend or change timeframes for the submission of bills of entry. And so there's some amendments being proposed here to clarify that and make it easier and allow for rules so that people will know where they stand. Move on to the next slide. This is also something to make life a little easier. Currently, if you have a bill of entry, which is the document you present when you're importing something, you want to change it, you have to do a voucher of correction. So what the idea is here is that under certain circumstances where it makes sense, we'll simply allow the lodgement of a substituted bill of entry rather than cancellation by way of a voucher of correction and then a replacement. Moving on. All right, so this one gets quite technical, so perhaps but just very briefly, when you import certain services, you are required to do what's known as a reverse charge. So because the supplier isn't registered for VAT in South Africa, you as the person who is registered in VAT charge yourself VAT, and then you will claim it back. Currently, the rule is you've got to do that within 30 days of the earlier of the date of the invoice or the payment. We've had representations that because these kinds of purchases don't go through the sales system, which is where VAT is normally charged, there can be lags in picking them up. And so a longer period would be appreciated. And that seemed like a reasonable suggestion. So the proposal is to extend the 30-day time period to 60 days. Moving on. All right, so now where we talk about non-residents with no or limited presence in South Africa, so these would be things like electronic service providers. So you can think of many of them, people who provide services that South Africans pay for. They will register for VAT, and then they will pay the VAT over to SARS, even though they are based outside of the country. There are also other people that will come into the country for short periods of time to do work, but will register for VAT for that purpose, but they don't have a fixed base in South Africa as such. So if you're a non-resident, it's actually very hard to get a bank account in South Africa. So the idea is that we will remove that as a requirement, as we have for electronic service providers, for people who do not have a presence in South Africa. But what we would then simultaneously want is somebody to be appointed as a representative for that entity. So that is the proposal here. What we will not permit are refunds into a foreign bank account because if you have significant enough presence in South Africa that you are generating refunds in the VAT system, then you probably have a significant enough presence that you should be registering for VAT and having a foreign, a local bank account. Sorry. Yep. Moving on. All right. So members who've been following the media will be aware that SARS takes its confidentiality extremely seriously, and the question arose as to whether certain records should be disclosed. Currently, there is, in the Promotion of Access to Information Act, an exclusion for taxpayer records. And the question was whether that was justified. The Constitutional Court ultimately found that the public interest override in the Promotion of Access to Information Act should apply in these cases, and that the public interest override that was contained in the Tax Administration Act did not suffice. That was a majority decision, 5-4. And so what is proposed here is that the Tax Administration Act, the Customs and Excise Act, and the Promotion of Access to Information Act all be amended to align with the reading in that the Constitutional Court handed down, so that there is alignment between the legislation and what the Constitutional Court found. Sorry, I should just add for the previous slide, this is something that we've engaged with the Department of Justice and Constitutional Development on. Moving on. So currently, if we have a legally qualified SARS person, that person may represent SARS in the tax court or the High Court, but we have very experienced personnel, and the question is, well, why just those courts? Why not in the Supreme Court of Appeal or the Constitutional Court? And so that is the proposal here. But equally, there has been some debate in recent years as to whether an ordinary person who is not a lawyer may represent a taxpayer in the tax court. In the High Court and onwards, there are separate rules, but in the tax court, the rules are in the Tax Administration Act, or in terms of the Tax Administration Act. And so the proposal is that you would permit such a person who is not a lawyer, maybe a tax practitioner, for example, or it may be an interested person in, for example, say, a company that has the competence to do this, that they be able to represent the taxpayer in the tax court, provided that the judge who's in charge of the tax court is satisfied that they're a fit and proper person. The next amendment here relates to, well, not the next slide, just the next bullet. So the point on the previous slide is that where SARS does represent, a SARS employee does represent SARS. Remember, this is now a legally qualified person, duly enrolled and admitted. As it stands at the moment, if we brief external counsel, we can recover costs for the external counsel, but if we save money and use internal legal counsel, then we cannot. It seems an odd incentive, so the proposal is to permit the recovery of costs for the use of the internal counsel, who would rather be cheaper than using external counsel. So this should be to everyone's benefits. And then there's just a technical point there at the end as to how the costs should be determined. Next slide. Currently, we can interview you if we think that will speed up the process of asking questions around an audit or verification. And the suggestion is that that kind of speeding up also be permitted where someone has applied for debt relief or where there's a recovery of a debt. Moving on. As it says here, the members will be aware of the auto assessment initiative that SARS has, where we've issued over 5 million auto assessments so that taxpayers don't need to complete a return. They can simply look at the assessment, see if it makes sense to them, aligns with their information. If so, they don't have to do anything. If they disagree, it's only then that they file a return. There have been some concerns that the legislative framework does have some small gaps in the space, and the proposal here is simply to address those gaps. Moving on. This one is something that's been quite widely welcomed by taxpayers. Currently, you can go into alternative dispute resolution once a matter is at the appeal stage, but there is an earlier stage, which is known as the objection stage. And the suggestion here is that alternative dispute resolution also be permitted here. That would obviously assist in resolving disputes faster and earlier in the process. But there is still a fair amount of detail that will need to be worked out in the rules. But the idea here is to at least create the enabling framework so that that can be looked into. Moving on. Right, so currently, if you are in that appeal stage and you are late in lodging your appeal, you can get an extension for a limited extension for what are known as reasonable circumstances. Then you can get a longer extension if there are extraordinary circumstances. But if you miss those two, then you are out of luck at that point. The process stops. That has created some difficulties. And so the proposal here is that if it is in the interests of justice, that the tax court is then empowered to give a further extension. But clearly that will be the exception to the rule. Moving on. All right. We're quite a bit into dispute resolution here. We're obviously trying to clean things up here and make it simpler and more streamlined. And this is just another aspect of that. Now, we have what's known as the tax board, and you can think of that almost as the small claims court of the tax world. That deals with smaller tax disputes. The problem is that at the moment, if either SARS or the taxpayer thinks it should go to the tax court, then it has to go to the tax court. The problem with that then is that the tax court role gets clogged up with a lot of smaller cases and makes dispute resolution there more difficult. So the proposal here is that instead of either being able to move it to the tax court, it is only if both agree that it needs to go to the tax court that it goes there. So that in the first case, it first goes to the tax board if it's one of these smaller matters. For those who are interested, the cutoff is R1 million. So it's not that small, but nevertheless. And then if you're dissatisfied with the tax board result, you can then take it on to the tax court. But if the tax board is able to resolve it, then it's resolved. Or if it's a particularly complex matter, maybe there's a principle at stake here, then you can skip the tax board and go directly to the tax court because both parties would agree. Moving on. This is a pretty technical one. Essentially, we have a rule that allows us to temporarily write items off under certain circumstances. This is really for SARS's accounting purposes. It doesn't impact the taxpayer. If something is temporarily written off, SARS can still recover the debt. And the accounting world has moved on since this provision was put in. So there's a proposal to remove business rescue from this because it's no longer required. Moving on. Skip the slide as well. A company or trust or other institution is required to have a public officer. So the person who is responsible for the tax affairs of that entity. So here we're dealing with companies. And so given that we now have a much more streamlined process for registering a company, it's essentially web-based. SIPC makes that portal available. You are allocated a tax number automatically when you're on that. So it's an all-integrated process. So the system that we currently have, which sort of presumes a paper registration and then a period for a piece of paper to be sent to SARS to say who the public officer is rather archaic. So the idea now is that when you form a company, you will nominate your public officer, and then that that, we can move on. It's all one seamless process. There aren't delays in it. And then if there is a situation where there isn't a public officer, there's a default set of rules provided that says, okay, these are the people who will be considered to be the public officer in sort of order of seniority. And that then means that SARS always has somebody that they can talk to if they need to deal with the public officer of a company. Moving on. Global minimum tax. Nhlanhla, back to you.
Thank you, Franz. Chair and honorable members, this is the new bill that we would like to introduce, the global minimum tax bill. The aim of it was basically to ensure that we are able to tax some of these multinationals that are paying less than 15% of tax. So these rules came as one of the efforts that came from the OECD G20 BEPS, Base Erosion and Profit Shifting Project, which was called BEPS. So then one of the aim as well for this one then is to make sure that to the extent that we do apply these rules, we should make sure that they are consistent across the board. Because then South Africa, of course, in 2021 also agreed to join these 135 other jurisdictions to ensure that multinationals do pay. So in order to make sure that at least the rules are consistent, then we just have to make sure that we then follow as close as possible to these global anti-base erosion rules. So hence then we then drafted this bill, and we drafted it by reference just to ensure that we are able to refer to what the OECD has done, and also just to make sure that we don't create either uncertainty or some sort of a duplication. Because one of them, I'm just going to mention while I'm also given this opportunity here to say, if you look at the same rules in the United Kingdom did the same rules, but they go up to 660 pages. So, but then they also, so in ourselves, then we thought that, but some of the countries as well, that also introduced these rules, they actually also went by reference, because it's actually much better to do the reference. Of course, any updates that will come up, let's say from the OECD, we're still going to go through the parliamentary process to be passed by the parliament. But basically, this was one of the bills that we're hoping it will be effective in ensuring that multinationals do actually pay the tax. And the 15% per se is calculated, let's say, for example, this entity has a subsidiary in country X where they're paying 5% of tax. And then now the difference between 5 and 15, so the 10 then will then be included in this, in the taxable income of that entity and be paid in South Africa. That's what we're trying to aim for. Then these global minimum tax rules are split into two. So at the moment, there is the rule called the income and inclusion rule, and we also then have the domestic minimum tax one. So there are other entities, of course, that are excluded from this globe rules, such as your government entities and non-profit organization and pension fund are also excluded from these rules. I'm going to try and make sure, because now I have to go through the clause of the bills, the current draft bill that was published on 21 Feb for comments. We did receive the comments from the stakeholders, and we had the workshop on the 6th and 7th of June. However, the current bill at the moment, it had some interpretation. The clause 1 per se got like interpretation that refers back to the global rules. And then, of course, then you have some of the clauses that talks to the fact that these rules must be applied and be interpreted consistently. And also one of the key issues as well is that the OECD afterwards, they will have the peer review mechanism where they will look into all of these countries and see if the rules are matching. So that's also one of the reasons why we actually followed the reference approach instead of importing the entire rules. It's what just like what UK did. And then, of course, then one of the clauses has the incoming inclusion rule that says who will be liable for this top-up tax. And then as well, we have the rules for the domestic minimum tax. And then we have the rules for transitional rules. We then have the rules that states that the tax that will be levied will be for the benefit of the National Revenue Fund. Of course, then we also have some of the rules that talks to the translation issues. If then there is some foreign currency, how will that amount be translated into South Africa? Because then there is a global minimum tax administration bill. Over to you, Franz.
Right, thank you very much. So perhaps just one aspect to add, because I think it's useful, and we'll see the point as I quickly run through the admin bill. The way the rules are set up is that if you have a qualifying minimum domestic top-up tax, that takes precedence over the holding company's income inclusion rule. So if you have a foreign subsidiary in South Africa that is, or a subsidiary of a foreign multinational in South Africa that is paying tax at less than 15%, if South Africa does nothing, that difference, and again to use the Ntlanhla's example, if they're paying 5% here and the difference of 10% would then be taxed in the holding company's jurisdiction, the ultimate parent entity, to be technically correct in this place. On the other hand, if South Africa says, hang on, you're under the 15%, we'll tax the 10% here in South Africa, then as long as we are following the global rules, the other jurisdiction will recognize the fact that 15% was paid in South Africa and will not tax anything in their jurisdiction. So you'll immediately see that there is an implicit incentive for countries to tax it in their own jurisdiction rather than to leave it for the jurisdiction of the ultimate parent entity to do the taxing. And that is why you will see that a lot of what would generally be considered to be low tax jurisdictions moving to introduce this kind of income inclusion rule and potentially also the domestic minimum top-up tax is to ensure that they're not leaving money on the table, so to speak, for another jurisdiction to take. With that bit of background, let's just move on to the next slide, please. So I think this just gives you a brief overview of what's in the proposed administration bill. So let me just skim very quickly through the slides, moving on to the next. Okay, so again, we're trying to be consistent with the global approach here. The inclusive framework has come up with these rules. It's a very large group of countries working together to come up with them. And so if you're trying to do something across all those borders, you do try to need to be as consistent as you can. And so that's the objective of these clauses. Moving on. So now, again, you have the potential for submitting a tax return in 10, 20, 50, 100 jurisdictions around the world. So there is now a standardized template that has been developed so that there's a degree of consistency. And because you may have multiple companies in South Africa as part of the group, you can have one company file on behalf of all of them. If you're going to do that, you need to let SARS know 6 months before the end of the due date for the filing. Moving on. All right, so what's the due date? Well, it's 15 months after the last day of the financial year, but there's an exception if it's the first year you're having to do this, either because the rules are new or because your company has just grown or your group has just grown to be big enough to fall into the rules, then you get 18 months. Moving on. Okay, so just as you can have a single company file on behalf of a domestic set of subsidiaries, so you can have one company internationally that files on behalf of the entire group internationally, and then the information is exchanged by way of exchange of information in terms of our tax treaties and what are known as competent authority agreements. And so that mechanism is in place. You don't have to file in South Africa because your ultimate parent entity or another entity is going to be filing on behalf of the whole group, and South Africa will be given a copy of the return. So it doesn't need to dig into it itself. And again, you need to let SARS know who this is going to be 6 months before the due date. Moving on. Due date for payment. Unlike some jurisdictions overseas, we haven't tried to go with some sort of a provisional tax system here. Having looked at some of the rules, that gets very complicated very quickly. So you are required to pay the tax when the return is due. Moving on. Refunds and interest. So if there's a refund due, perhaps you paid too much, you discover an error, you put a revised return in, there's a refund due, that will be paid over to you. On the other hand, or if you owe, and that will be subject to interest. On the other hand, if you've got the return in but you've underpaid SARS, then you owe SARS interest. Moving on. Penalties. So each jurisdiction is free to set its own penalties. The penalty that is being proposed here is similar to the kind of penalty you would see if a promoter of a reportable arrangement, or in other words, something that looks rather like a tax avoidance scheme, fails to report it to SARS. And so that's the penalty of 50,000 Rand a month, which we hope is big enough to grab the attention of these large multinationals. May not be, in which case maybe it should be a little higher, but that's something that I'm sure will come up in the public consultation process. Now, moving on to retention of records. Normally there is a 5-year rule for retaining your records, but because there is a look back in the 5th year to see if certain things you took into account in the 1st year actually happened or not, there is a requirement then to keep the records for longer, which is covered in the proposed. Moving on. That is it. Nhlanhla, I'll hand back to you.
No, thank you, Franz, and thank you, colleagues, for putting up this presentation together. Now, Chair, as you note, that we did jump a couple of slides as well, but we were willing to go through them if the Chair or the committee so wishes. I will now hand over to you, Chair. Thank you, sir.
Thank you, SARS and National Treasury. Let's move to the next item for questions and comments by members. Over to you, honorable members. Let me note the names here. Honorable Beasley, Honorable Van Rooyen, who's phone? We don't have this member here. Who's that?
It's Honorable Tambo, Chair. Should change that. Honorable Tambo, EFF.
Okay. Honorable Tambo. Honorable Squatty. Okay. In that order. Mautu, are you raising a hand?
My hand is up, Chair. It's very black, like me.
Why would you color so Honorable Mautu. Who else? Alan Duty, can you see somebody whom I can't see from my side? Because Honorable Beasley and Ryan, Tambo, Squatty, Mautu. Who else?
That's it, Chair.
Okay, that's it for now. Honorable Beasley.
Thanks, Chair and colleagues and people from Treasury and SARS. So as a new member, I'm just trying to understand the logistics and how it all works, because in the budget speech, the minister would have said, we're putting up excise duty on alcohol by 6%. When would that be effective? Because these bills still have to be approved. So when the minister announces a 6% increase in excise on, say, on alcohol, when is that actually effective? Because if these still have to be approved. And then the second question is in terms of the incentives for the electric vehicles. We talk about qualifying expenditure. What is that qualifying expenditure, and how did we get to the figure of 150%? I'd just be interested to know. And then that the respective amendment to the fuel products, I'd just be interested to know that the quantum amount, because it does seem a bit unconstitutional and does seem a bit unfair that SARS can go back and retrospectively change. It just doesn't seem constitutionally right that SARS can go back in time and change the rules. So I'll just be interested to know more detail about that. Thanks, Jeff.
Thanks, Honorable Beasley. Honorable Van Ryn.
Thank you very much, Chair. And a very good morning to you and the collective of the Standing Committee of Finance. Let me start by welcoming the presentation that has been put together by the team. Chair, I've got some few questions and, of course, a bit of a comment. I just want to understand in terms of processes. The presentation is referring to workshops conducted. I'm not sure who participated in these workshops, but also what is our role as MPs in those workshops, if there was any role to be played by us. And a link to that, Chair, the fact that this is a new administration reminds me of the need to pose a question on the MP's capacitation around tax-related issues. I'm not sure is there any provision for such, or maybe is there any advice that we can maybe get from SARS on specific training, even if it's not training, something like training for non-tax practitioners, just to empower public representative around taxation issues, because taxation issues by nature, they are extremely technical, and at times it becomes very difficult, to conduct effective oversight on such issues, more especially if we don't pay attention on how do we capacitate public representatives to deal with this assignment. On the carbon tax, Chair, I can see it cites there the implementation was done in January 2024. I'm not sure, maybe it's a typing error, or maybe they were trying to communicate something there. But then if that happened, the implementation was done in January, then what is the essence of this process? Why this thing is only brought to us now if the implementation was done, has been given effect already? On the teapot retirement system, as much as it's clear that there was the tax directive was done after the seed capital has been released, but I know that in the public discourse, here I'm relying now on what I heard from the media. There's been submissions from, more especially from Labour, around exemption of the taxation on seed capital as part of income realized by affected taxpayers. And I don't hear the team saying anything about that submission, if that submission was ever done. But I think it will be important also just to hear from the team. What is the team view about this particular submission from Labour? And on the automotive sector, Chair, I just wanted the team to go a bit deeper around what should we expect when we speak of 150 percentage tax provision in terms of the application thereof. What should we expect? Or maybe what should those in the industry expect as we speak of this 150 tax provision? How is this going to be applied? Can they just give a small example on how is this whole thing going to apply? And on the retrospective amendment, Chair, I'm not sure what will be the implication of this retrospective amendment to the taxpayer, or also to the mandate of SARS itself, to the mandate of SARS itself, of this retrospective amendment. What will be the financial implications of this to the taxpayer or to the tax mandate itself? And there was a reference to, Chair, the issue of some taxpayers calling for the utilization of tax court instead of the tax board. But I didn't hear what might be the cause of such a call. Because definitely, from where I'm seated, there might be some dissatisfaction about the performance of the board. So maybe can that be clarified by the team as to what might be maybe causing this particular call? And lastly, Chair, something very interesting, I mean, for me as a public representative, is the impact of these bills on mainly key 4 areas. The first area being the transformation mandate on the financial sector, but also the impact of these amendments on the poorest of the poor, our people. And thirdly, what is the impact in terms of SARS mandate itself of these bills in as far as revenue enhancement is concerned? And lastly, on this global minimum tax bill, how is this going to ensure that companies are somehow encouraged to invest in the foreign jurisdictions? What will be the impact of this bill in as far as the promotion of participation of South African companies in the foreign jurisdictions? Thank you very much.
Thanks, Honorable Van Rooyen. Honorable Tambo.
Thank you, Chairperson. I'll try to be very brief. Greetings to you, to the teams present here, to the rest of the committee. My main interest is in the Revenue Laws Amendment Bill, or the two-part system. I think for public consumption purposes and benefit, we should refer to it as that so that it can be more accessible. Because my main concern with regards to SARS and the Revenue Laws Amendment Bill, the two-part system, that I think there hasn't been enough necessary public education on the tax implications of this new reform. So instead of it being the progressive tax reform that we all imagined it to be and supported, it has become one of the massive revenue collection areas for SARS, and they have not done enough, in my view. Perhaps they'll enlighten us, and we can't speak on what was discussed last year since we're new here. But in my view, I don't think there was enough necessary education on the tax implications of the system itself. And I see the measures that have been mentioned here today, like withdrawals, there'll be no tax directive requirements on the transfer of seed capital to the savings component or an intra-fund transfers. This all seems as more administrative amendments that make it easier for SARS to fast-track its revenue collection process rather than actually beneficial to the consumer at an educational level. So I think I'll ask two questions, and it's for my benefit and for the public as well, because I want to have an understanding on two levels, is how SARS is going to classify the revenue it generates from two-part system taxation withdrawals or taxation of the withdrawals itself. What category is it going to fall under? And does SARS have an estimate of how much revenue it's going to generate from the tax it puts on the two-part system itself? Because as I'm curious, Chairperson, whether when SARS declares the revenue it has collected, will there be an explicit sort of distinction to state that this amount was drawn from the taxation of pension fund withdrawals? Because we know in the first week in itself, I think from the 1st to the 10th of September, about 4 billion worth of claims were made. And SARS has issued about 161,000 or so tax directive applications from retirement fund administrators. So I'm curious when, because SARS is definitely going to declare large revenue collection out of this process. So I wonder if there'll be distinction with those statistics from general revenue collection processes as well. And then the second issue I'd like to raise, Chair, and I think it's important to raise in this meeting because it's something prevailing in society and maybe SARS will be able to assist us, is the report of the FSCA, the Financial Sector Conduct Authority, on the non-compliance of payments towards the pension funds, which directly implicates the effectiveness of this legislation. Like, if there's no funds, so to summarize, the report by the FSCA is that municipalities and private security companies and other retail outlets have not been making payments to pension funds, and therefore the two-part system becomes ineffective because when workers want to withdraw, there's no money there. And I think the pension funds adjudicator as well last week raised this concern of about more than 80% of its caseload being related to the emptiness of the pension funds itself. Does SARS have any concern about this? Is it concerned about how it might affect its revenue collection from the two-part withdrawal system? Because it has this trickle-down effect that I've mentioned on the Revenue Laws Amendment Bill is not going to be effective. And what is the role of SARS in that regard? Because what does SARS do to combat non-compliance by companies, I think specifically, which ostensibly have these tax responsibilities towards SARS, but violate laws that impact legislation that SARS has to work with, if I'm making sense. So I hope it doesn't sound misplaced, but I think we need to have an understanding as the public as well of what role SARS plays, because surely there has to be a link between tax compliance, pension fund non-compliance, and effectiveness of the Revenue Laws Amendment Bill we're discussing here today. Because SARS can't simply play an extractive role with regard to the Revenue Laws Amendment Bill. There has to be some level of compliance role. Because what is SARS' role when fund administrators have mismanaged the funds? I was saying SARS only just collects taxes, but when laws are broken and the effectiveness of legislation is undermined, there's nothing that SARS can do. So I think my curiosity is premised solely around that Revenue Laws Amendment Bill and what SARS is doing as we've encountered this prevailing challenge of non-compliance. Thank you, Chair.
Thanks, Honorable Tambo. Honorable Squat.
Thanks, Chair, and good morning to colleagues and the presenters. And allow me, Chair, to also join my colleagues in welcoming the presentation. Chair, mine it's one, the issue of the global minimum tax bill. I just want to understand. I understand the positive side of it that you'll then be able to have mother companies or parent companies being able to make sure that they pay tax in the countries where their subsidiaries are operating, but as well make sure that they don't get scot-free. But Chair, I want to understand the risk that is there, because majority of the major companies that are in the country, particularly where we are actually getting our tax revenue to cite one, the mining companies, majority of them are actually foreign companies. What is the level of the risk in terms of them paying the tax in their countries of origin, as opposed to where they are operating, and as us losing, part of the tax revenue that we're supposed to be getting in that regard. And secondly, Chair, it's the issue of capping of abuse of employment tax incentive scheme. I did not get properly the punitive measures that are being suggested or proposed in terms of dealing with that, so that we don't find ourselves going to an extent of eroding or eradicating this incentive scheme, which is actually working in many other areas, but also be able to just deal with those that are actually delinquents. Yeah, I think those would be the only issues. Thank you.
Thanks, Honorable Scott. Honorable Bound.
No, thank you, Chair, and greetings to the colleagues and the officials from both SARS and National Treasury. Chair, I raised this question, I think, last week or 2 weeks ago, that the taxation system of this country really, it's aimed at impoverishing even the poorest of the poor. All these amendments that have been brought forward, including the laws now that relates to tax, they are in favor of companies than people. So we're actually making the rich to be more richer and the poor to be more poorer. And I'll illustrate my point. I mean, the last time I went at length explaining this claim that I'm making, but I'll talk to it just now when I talk about the two-pot system. So with the amendments that are coming from National Treasury, and that's one of the things that I raised last week, and the colleague from National Treasury couldn't understand what I meant by the sponsor. It's exactly what they're bringing now. Those amendments that are due to the announcement by the minister during the budget speech. So how long does it take, or what is expected of this committee to take in terms of timelines to finalize those amendments? Because the minister presents twice in Parliament. Firstly is the budget speech in February, and then it's the MBTPS. Yeah, sometime September, October. So by the time that happens, would we be done with all the amendments? And if so, do the changes that are being requested here now, are they going to be applied retrospectively or not? And what is the danger of us not finalizing and going into the new financial year with now even more added amendments that could come from the minister? That's one. Two, Chair, slide 51, I couldn't get exactly what the presenter was talking about in terms of the applicable fuel products. I missed the point. What exactly is it? Maybe if you can repeat or just put an emphasis on what is being proposed on slide 51. On slide 52, I'm going to also join my colleagues in terms of the retrospective amendment that is being proposed. And I heard the presenter saying that I think it's not Arno, I don't know. It's one of the colleagues saying that SARS received an advice that it will not be unconstitutional. And he speaks about an amendment that wants to address something as back as 2002. I don't know how that is going to work, Chair. And has SARS or National Treasury done the financial impact of this amendment? And in their financial assessment or impact model that they've done, do we stand to lose or gain from this amendment? Because if we are to lose, how much are we losing and what will it do to already stressed and stretched budget that we have, constrained budget we have? That's another one. And then, Chair, on the international corporations filing and South Africa being able to get a copy, I don't know. So what happens when there are reviews? And what happens when, SARS says, but there's an issue here, there's a concern here. So how does the process go about? Because if I'm here and I've filed my financials and SARS has got an issue, I'm here, they can contact me, we discuss until we finalize. So this one that is going to be accessed through the system in terms of a multi-corporation, what then becomes the process? And it's SARS get up for this. So you'll have somebody who is in constant communication with this multi-corporation, which is the head office is in Brazil or wherever. How is SARS going to handle this one? So going back to the two-part system, Chair, and I know that it was passed by this committee, and I honestly don't want to take it back, but I don't know. Do we get that the problem statement that led to this two-part system being implemented has actually been achieved? So what were you trying to resolve? And I'm saying this, Chair, because you see insurance companies making more money than anybody else, not even what SARS is making. So we do know that when you apply to access that savings now, there'll be a tax implication on it. But is National Treasury actually aware that insurance companies are actually making far much more money? And they come with a claim that, look, we had to develop our system or adjust it to make this possible. And there's also administrative, work that comes in. And so they are charging really high costs on us as the workers. So I think this scheme, it would have had a good intentions for the workers, but in the main, what I'm seeing and what I'm actually saying this, Chair, because we come from the Public Office Bearers Pension Fund Board last week, which there was a presentation on this two-part system, and it is very clear that insurance companies are actually making far much more money than they could. So I just want to ask, what was the intent of this, and do we think that we're achieving it, and perhaps what can be done to rescue the situation? Because I do not think that the intention was to enrich insurance companies. I don't think so. And if the workers could be aware that actually you accessing that money, you are making, the insurance are making far much more than you, I don't think it will be a desirable thing. That will be all for me for now, Chair. Thank you.
Thanks, Honorable Mautwe. SARS and National Treasury, you will remember last week we raised a question in relation to the President's speech during the opening of the Parliament, where the President said, let me quote him so that I don't speak for him. as the GNU will look to expand the basket of essential food items exempt from VAT and undertake a comprehensive review of administered prices, including the fuel price formula, to identify areas where prices can be reduced. So here you are tabling tax bills. Can you please speak to the president's speech when he was opening Parliament? Where does this statement by the president of exempting more food items fit in all these bills that you have presented? Because we will not, as Parliament, have a president making a speech, the speech get debated by parliamentarians for that week, that there's no action in regard to the policy speech by the president. So simplify this and say, this is what the president said, and this is how the taxation bills are going to affect the president's commitment. Because when the president speaks, he speaks to the nation. He does not speak to a certain sector of a nation. Everybody listens, and his speech is like a decision. So he's not negotiating with SARS or with National Treasury or with anybody. Whatever he says, it must happen because he's the head of state, he's the head of government. I think members have raised the issue of retrospective amendment. I don't think it would be right for you to come to a committee of parliament to tell us that we must legislate up to when previously. Bills are not passed in that manner. You come with a bill in parliament and say, here's the bill, we process it. Then the president decides on the date of the implementation of that bill. I don't know of a situation where if it was there, you have to explain to us. And I think in this regard, you are making life very difficult for parliament. And I don't think you should do that as a national treasurer. Please, it is the president who promulgate a bill, assent to it, and decide on the date of its implementation, as he's doing now with all the bills that is signing. But for Parliament to decide that the bill will start to be applicable from when, and we don't have the study on the implications and all those things, I don't think that should be proper. Over to you, National Treasurer.
Thank you very much, Chair, Honourable Chair and Honourable Members. I'll try and go through all the comments and give my initial perspective. My team can then come in after me and either add or potentially correct anything that I've gotten wrong. And to start, there was some questions on the logistics, and quite a few comments were raised from the honourable members about when are these amendments actually effective, and what is the point of the legislation coming to us now if that amendment was effective before. So Parliament has passed legislation previously where, for example, in the Income Tax Act, the minister may stand up and make a decision to change a rate, for example, the personal income tax rates, and those rates can become effective either then or very soon after the minister announces. And Parliament has 12 months to pass that bill to then make that change effective, for it to be legislatively correct. So they've got 12 months, Parliament has 12 months after the announcement, but the actual change in the rate can be effective almost immediately. So in terms of excise duties on alcohol, it is effective immediately. And then there are 12 months for government to get that legislation through for it to have remained effective from the date of implementation. So this is included within the Act, and it is one of the provisions that is available to the Minister to make those changes, and in effect, Parliament would then discuss and approve after. And if not, it would need to be unwound. And perhaps my SARS colleagues can also talk a little bit about that. In terms of electric vehicles, what's the qualifying expenditure? So a lot of that details in the bill, and I can get my colleagues to come in to give some of it, but it's for new expenditure on electric or hydrogen vehicles. How did we get to the figure of 150%? We worked quite closely with the DTIC to see what is an effective incentive as you compare it to a lot of other international positions. So what do other countries offer? Is it going to be as attractive? Because a lot of these companies can then decide, well, we'll either produce in the country A or country B, and they will look at the different regimes in those countries. So we had to look at the international comparisons. The 150% was seen to be sufficiently attractive to hopefully get those automobile manufacturers to manufacture that either electric or hydrogen vehicles locally. The retrospective amendment to the fuel product, there were also quite a few questions on this. So maybe I can try and say it a bit more bluntly. This is a technical correction which makes sure that diesel is actually taxed. If, according to the letter of the law, in this very technical application of the wording as it stands, there is a chance that it might be interpreted that diesel would not be taxed. If that were to be true, government would lose billions of rand, billions and billions. So we need to make this technical amendment to make sure that diesel continues to be taxed in the way it is currently taxed. The amendment is going back to 2002 because that was when that change takes place. But in all those years since 2002, diesel has been taxed in the way we had expected it to. And the revenue that we've been receiving every year is based on the fact that this diesel is taxed. But according to this very technical interpretation, there is a risk that it might not be taxed, which means that there would be huge refunds that government would need to pay. So in effect, this change is basically keeping the policy status quo. The policy was always to tax diesel, and that by making this amendment, the diesel will continue to be taxed. I can ask SARS to come in and give further details on that, but from a policy perspective, that's the issue here. Without this amendment, there's a risk that it might not be taxed, and SARS and government would have to give billions back in refunds, which we are trying to avoid. In terms of the processes, the workshops. So the workshops we do are with taxpayers who have commented on the bill. And the aim of those workshops, and it's for anybody who's commented on the bill, not just taxpayers. So we've published the draft bills at the time of the budget. We also published the Taxation Laws Amendment Bill on the 1st of August. Those get put out on our website. Anybody can comment on them. For the commentators who do, we invite them to workshop, and the aim of the workshops is just to understand their queries better from our side. It's not a negotiation, it's just for us to understand. So if they've said, no, this wording in this bill doesn't quite make sense because of this, we can ask questions to try and get further details so that we have a better understanding of what their comments are, and we can consider it better. In my view, I don't think MPs need to go to those workshops, but they are by all means invited to them so that we can, if you'd like to come at the beginning of this administration to some of those workshops, you're very welcome to come and see the types of discussions that go on. And they are usually saying, commentator X, you said this. Can you please explain a bit more about what you mean? We thought it was this. Is that correct? And that is how we do it. On the carbon tax, that's the same as that implementation issue. On the two-pot system, there have been submissions to say that the seeding capital should not be taxed. There were some other comments on about from other members. In our view, and we've been quite firm on this, is that the amounts in those funds have never been taxed. Individuals got a tax deduction for when they contributed it. So there was no income tax paid on the amount that went into those funds. Similarly, there's no tax on the growth within those funds. So there's no capital gains tax, there's no dividends, there's no interest tax. So no tax has ever been paid. Before the two-pot system, if you were to take any money out of your fund, tax would then apply. And at the moment in the old system, if you were resigned or were retrenched, you could take money out and we would tax it based on a withdrawal tax table or a retirement tax table. So the tax was paid there. SARS makes about 12 billion rand per year from the tax that is charged when people withdraw. When we looked at this, we did not like the implications of that, because according to those tax tables on how much you get taxed when you withdraw under the old system, it's just based on how much you have withdrawn over time. So even if you have no income and you withdraw above 25,000 Rand under the old system, you would start to be charged tax, and it would go from 18% to 27% to 36%, regardless of how much income you have today. Under the new system, this income, the withdrawal gets added to your income, which means that for individuals who have no or very low income, they won't be paying any tax. If they have a withdrawal from the two-pot system and the income in that year and the withdrawal does not exceed 95,750 Rand, there is zero tax to be paid. However, if you have a high income and you withdraw from the two-pot system, you will be taxed a higher amount to make it progressive. And the whole point of the system is to be progressive and to try and help those on lower incomes. If you have a lot of income, you shouldn't be withdrawing the money because you have a lot of income. It acts as a disincentive as well. Tax needs to be paid at some point. We couldn't have a system where people can withdraw money out of their funds and no tax was ever paid. In our view, that isn't progressive. On the automotive sector, can we give a small example? So on the 150%, just as a small example, if an automotive manufacturer were to spend, let's say, 10 million Rand on building a new electric vehicle manufacturing assembly, they're spending, how much did I say? 10 million Rand. That means that they will be able to deduct from their corporate income tax 15 million Rand, 150%. So it works by saying the amount that they have spent on that investment, they can deduct 150% of that amount from their corporate income tax liability. So in effect, it's 150% times 27% that they will then get as a rebate, because 27% is the corporate income tax rate. I think I've spoken about the retrospective amendments. France, I don't know if you can talk about the tax court and the tax board. I wasn't quite sure about that. The global minimum tax, there were also a few questions there about how is this going to impact companies, both those who invest offshore or others that try to come locally. So the nice design feature of this global minimum tax, this Pillar 2, is that all countries are doing it, especially our main trading partners, which means that there's now no disincentive for a company either to go offshore or for a company to come to South Africa, because they will pay that same amount regardless. The only thing is, who will they pay it to? So for a multinational, they will pay that money whether they locate in country A or country B. And for them, it doesn't really matter which government they pay it to, but they will pay the same amount. So there's no disincentive for South African countries to go offshore or for offshore companies to come to South Africa. They can't get away from the tax regardless of where they locate. So it's not going to have an impact on their investment decision, which is one of the nice design features of this. I think we've spoken about the two-part system, the administrative impacts. How do we classify revenue? Do we have an estimate? So in the budget in February, National Treasury published an estimate. We thought we would make about 5 billion Rand in additional tax revenue from the two-part system. And that must be compared to the around about 12 billion rand that we currently make from withdrawals in retirement funds. So that is the amount. It varies broadly. Some analysts have a higher amount, some analysts have a lower amount. We think it's relatively conservative. The administrative mechanisms in this bill are to try and make it easier. It's not for SARS to try and get more money. This has never been a revenue-raising policy. The government was not implementing this policy in order to raise revenue. As I was saying previously, it's just about making sure that tax is paid at some point. These amendments are just to make it easier and simpler so that the administrative costs to the insurers are lower, so that hopefully the insurers then won't charge members as much for implementing the system. So this is to try and reduce those costs, to make it simpler and easier for everyone, and it's not just about revenue. The employment tax incentive scheme, there have been a number of schemes there where, for example, they would sign up students for training. A company would sign students up for training. They would get them to sign a piece of paper. And then that company would put that student on the payroll and claim an employment tax incentive, but they would not be paying that individual for anything. In effect, they would say that the training is covered by the cost of their wage, and then they would just claim the incentive. And that is completely against the rationale of the scheme and undermines this incentive and employment generation. So we need to try and close these types of schemes down. Otherwise, they will lead to a loss in revenue for no additional benefit. I would quite strongly disagree that the tax system is trying to impoverish the poor and it's in favor of companies and the people. A lot of our system is there. It is a progressive where those who earn higher incomes pay a much higher tax. A lot of the amendments you see in this bill today, in these bills, are to curb any loopholes, to curb structures, to reduce taxes for companies. There's a new global minimum tax so that all companies do pay. A lot of what we do every year is to make sure that companies and high income individuals pay their fair share, and we don't unnecessarily tax the poorest of the poor. We do that in everything that we try to do, and we don't put new tax measures on the poor without very, very serious consideration. So we would quite strongly disagree with that opinion. I think I've spoken about the fuel levies, I've spoken about the M&Es, the two parts. Chair, on your question on from the President, that the GNU will look to expand the basket of zero-rated goods and do a comprehensive review of administered prices. And that is certainly what we are doing, Honourable Chair. So we are looking at what we can potentially do to expand the basket of zero-rated goods. A lot of the administrative prices sit with some of the other departments, for example, the DMRE and NERSA. But we can provide some inputs into that. But our main role in tax in this unit is most certainly on what can be done on the basket of zero-rated goods. The bills that you see today, like how does it fit in with these bills? These bills all relate to previous announcements that have been made by the minister already. We can't include any amendments unless they have been made by the minister. So in terms of what the President has asked, we will look into that expansion and assess what we could potentially do. Once we have done that, the minister can then potentially make an announcement. And then after the minister has made an announcement, we can bring those legislative bills to Parliament to enact those announcements. On the dates of implementation, Honourable Chair, a lot of the tax measures do come with a date of implementation. So for example, the two-part system came with a particular date, 1 September. In the tax system, the certainty is really required to have that date so that everybody can finally get ready for implementing those changes. So in all the bills that we've done, and you can look back, Honourable Chair, various years going back a very long time. On the tax side, we try and include a date of implementation to give the public and administrators and SARS certainty about what will change and when, so it can be implemented correctly. I think that covers everything. I can ask my colleagues to come in now. Nhlanhla, Warren, anybody else? And then France. Thank you, Chair.
No, thank you, Chris. No, nothing further from my side. Thanks.
France?
Great, thanks. So a few points in my direction. You made the point about taxes that come into effect when the minister speaks, so the excise duties. So those would take effect immediately, as you've mentioned, and they would remain in force for a year unless Parliament decided not to ratify them. If Parliament decided not to ratify them, they would fall away at the end of the year, essentially. So hopefully that just gives a little bit of clarity. There are other areas where you are not dealing with periods, so income tax, where again, the announcement holds for a year, but if that was not ratified by Parliament, then it would unwind because we have an annual assessment cycle, which then makes that practical. I think you've dealt quite comprehensively with the retrospective amendment around the fuel products. To put it bluntly, if we were not to make this amendment, we would open the door for large fuel companies to get a refund of tax and maintain it for their own profit. That is something that we do not believe is fair to the general public or to the fisc. And so that is why the amendment is proposed. To the point on constitutionality, if you have a look at the Constitution, it is criminal legislation that may not be passed retrospectively. The Constitution is very clear on that. An offence was not a crime in either domestic or international law. You cannot retrospectively make it a crime and prosecute someone for it. And that clearly is inspired by the history of this country. On the other hand, there is no prohibition on retrospective legislation in other contexts. And it does happen in the tax context. It has been challenged in the courts, and retrospective legislation has been upheld in the courts. So I hope that helps members who feel that. I think you've touched on the amount that is involved. So that is quite significant. And as you pointed out, if there is no impact on taxpayers that would be affected by this legislation, the retrospective amendment, except that we are denying them an unexpected windfall, which, again, I think members would want to consider whether they wish to give unexpected windfalls to large fuel companies. Right, so there were some questions around the two-part system. I think you've dealt with them. There was the point about the FSCA reporting non-compliance. So each of us has a regulatory space. SARS is responsible for regulating tax. So if we were to pick up that there was an issue, there is an exception in the Tax Administration Act so that we could notify the FSCA that we have picked up something that they should be taking account of in their regulatory activities. Equally, if the FSCA picks up something and it's got a tax impact, they can notify SARS and say, we have found something that impacts on your space of regulation. But I think it would be quite difficult for us to start regulating each other's affairs. I mean, how you would quite make that work would be quite a challenge. And in any event, if you have a look at the SARS Act, what we are about is collecting tax. So it is what we are created for, it is what we do, but recognizing that we exist within a government, that there is a need to have a joined up government. And hence, if you have a look at the Tax Administration Act, there are what we call gateways that allow SARS to pass information on to, for example, the FSCA or the Reserve Bank to enable proper regulation. Equally, and this is a more topical one, a little bit off subject perhaps, but in We have recently amended that legislation to allow SARS to exchange information with the Master's Office and with SIPSI, all as part of our efforts to ensure that there's accurate beneficial ownership information in this country, which would go some way to helping us get off the grey list. So as you can see, SARS has a mandate, but we work closely with other government departments in such a way as not to endanger taxpayers' perception of confidentiality of their affairs, because if you think about it, SARS has a very large amount of very personal information about taxpayers. I think that deals with it from my side. Thanks.
Thanks, Frans. Anyone else from Treasury or SARS? If not, I think we're done, Honourable Chair.
Okay. Follow-up questions, Honourable Van Rooyen. Who else want to make a follow-up question?
Chair Tambo.
Honourable Tambo. Honourable Makoena. Honourable Scott. Yeah. So now that's that. Honourable Van Rooyen.
Thank you, Chair. Thank you to Treasurer for those who responded to our questions. Chair, I've got 3 follow-up questions. If they can just cite the provision of the Act that allows this passing of the tax bill, and we approve later or we rubber stamp later. Can they just refer us to that specific legislative provision in the Act? Secondly, I got more confused on the retrospective amendment, because at some stage the response was saying diesel can be taxed, and diesel is paying tax, and we are avoiding diesel not to be taxed. And now to compound it further, there was a submission that speak of the possible or the unexpected windfall that might be accrued to service providers. I'm more confused, in fact. I will still need clarity on this retrospective amendment and its impact, more especially financial. But lastly, Chair, not unless I didn't understand the response properly, please take me through once more. Be patient with me and take me through once more. 150% of a 10 million, your simple example, of a 10 million investment, yielding 15 million of tax, claim. What does this mean to our National Revenue Fund? Thank you, Chair.
Thanks, Honourable Tambo.
No, thank you, Chair. Just quickly, and I think firstly, let me appreciate the responses. I think they're important, not only for us, but also for the public to have an appreciation. I accept that there's a separation of regulatory authority between SARS and the FSCA. But I think what I liked from the response from the representatives from SARS is that they do acknowledge that there is a cooperative work that ought to be done to ensure that all spheres of regulatory competence in the financial sector are addressed appropriately. So I just wanted to wonder now that, and I'm sure it wasn't the first time that this has come to SARS' attention, that there's been non-compliance by companies and municipalities with the Pension Funds Act. Now that has been brought to your attention and the potential tax implications of this, because whether we like it or not, the non-compliance of certain companies from paying towards the pension funds of workers will impact the anticipated revenue collection projections of SARS, because if they didn't pay their pension contributions to the relative pension funds, then certain withdrawals which SARS may have estimated to be made won't be made, and certain projections will not apply. So that's why I was emphasizing the point that this non-compliance has an impact on the effectiveness of the Revenue Laws Amendment Bill, the two-part system. So now that this is clear that there is a level of correlation between non-compliance of payments towards pension funds and the effectiveness of the legislation that we're discussing here today, will there be any attempt to interact with the FSCA, or should FSCA make that attempt because it's non-compliance in their sphere of regulation that is going to impact legislation such as the Revenue Laws Amendment Bill? Should the FSCA be the one that comes forward to SARS? Should SARS reach out to the FSCA? Should this committee reach out to both institutions to come and make a presentation of these implications on this very law itself? What would be the ideal situation? Because there is correlations, there are links that exist, and how do we ensure that all regulatory institutions play the role that they're supposed to play? Thank you very much.
Thank you, Honorable Tambo. Honorable Makuben.
Thank you, Chairperson. Now, Chair, Treasury has a roadmap, or yes, I would call it a roadmap, or a structure that they need to follow, which would lead them to the processes of taking us out of the grey listing. Now, in the previous administration, the Minister of Finance came to Parliament and gave us a presentation, and also gave us steps on what Treasury is doing to ensure that we get out of this grey listing status. Now, I want to find out from Treasury if they are able to share with us the processes that they have followed thus far, and also the progress that they are making in terms of ensuring that all the issues that resulted to us being grey listed are actually corrected. Can we then be given a progress report so that we understand and we are able to then hold the department and the minister accountable in terms of what he presented to us in the previous administration, to say this is the processes that they are going to be following to ensure that they get out of, we as a country get out of this status that we are, because it does put us in a view that says investors would not be wanting to invest with us when we are grey listed, but they would opt for other economies that would not be grey listed. And then on our side, Chair, you know, this two-pot system was initiated to address a particular problem. Now, listening to what media is reporting and ordinary citizens who have tapped into this system or this process of the two-pot system, I'm tempted, Chair, to perhaps request Treasury to actually do maybe a study in the short term for the next 6 months to say, has this system, where has it put the citizens who tapped into this system because they were wanting to be alleviated from the frustrations that they were confronted with, which were high deaths, high death rates. You know, they had many deaths and just could not put ends meet. So looking at it, you know, from my point of view, Chair, is that I see South Africans being worse off than they were before these two-pot systems. So in essence, we have not addressed a particular problem which citizens requested us to address in terms of them tapping into their savings to be able to pay off debts and be able to live a comfortable life. But however, I think if we allow perhaps Treasury to give us a report or commission a study around what was the impact, we will be able to measure and see whether we not come up with a system that will be able to alleviate the challenges that citizens are facing in the country. And I see more of them still opting, Chair, to resign than to tap into this two-pot system, because we were trying to address a situation which many of them were left with no options but to resign so that they tap into their savings. And then there was a question, Chair, which was asked not in the previous, but the meeting which we had with Treasury and SARS. Yes, I think, yeah, it was Treasury and SARS in Parliament 2 weeks ago. That the question was around the taxation of your companies that operate here in South Africa, especially your Ubers and your Airbnbs. And I did not get the response properly. I'm still going back to that question again, Chair, to say you have these companies, your Airbnbs, they operate in the electronic media space. You have your Ubers, but what is the revenue collection for South Africa from these companies that, or these multinational global companies that have taken up our market space without even regulated, because your Airbnbs are not yet even regulated. You cannot, or government has attempted to try and regulate Airbnbs, because if you want to change your house into a guest house, the municipality must rezone your property, and but Airbnbs can just list their properties and people come and they use it for accommodation and revenues is collected. I would want to get a response to that particular question, Chair, because it was not properly or sufficiently responded to. Thank you.
Thanks, Honorable Makubele. Honorable Scott.
Thanks, Chair. So mine is still on the tax incentive scheme for youth employment, because the response that I'm getting, it's not that there are punitive measures that are being taken against employers who are not really dealing with the scheme in a proper manner. But it looks for me like it's punitive measures against those young people who want to participate within the scheme. And I'm saying it shouldn't be that because there are challenges. Therefore, we punish those young people who are supposed to be benefiting out of the scheme. Because I thought what the department would say is that in the light of these abuses of the scheme, these are the kind of measures that we are putting in place. Or alternatively, this is a new program or incentive scheme that we are creating for the employment creation. I mean, for the easing of unemployment for young people in the country. Because just eradicating the scheme or scrapping the scheme does not necessarily provide any answers to the challenges that we are faced with. Because you have got these unscrupulous employers out there. Well, I really don't think it's actually responding positively to the needs of those young people. Thanks, Chair.
Thanks, Honorable Squati. Just to make a follow-up on this issue of electric vehicle, have you consulted widely with the automobile industry, or your government is just taking a unilateral decision that let's have 150% for electric vehicle? And what will be the impact of this decision be on a competition with those who are still in the gasoline driven vehicles? Has this issue been widely canvassed so that if other automobile companies come to us and say, Parliament, you passed this bill, but we think it is unfair to us, will it not bring an unfair competition in the market? The issue of the president speaking, SARS Treasury must tell us when are they going to implement this. Whether if you come back in October, you must tell us. You said these bills are coming from the last budget, fine, but the president has spoken. So tell us today, when will the president's commitment be implemented? We are politicians here, and we carry out the mandate from our constituencies. And what the president has said has brought relief to the public. And you yourself, as a Department of Treasury, you also take instructions from the higher office, which is the presidency, through your minister. So the minister must do what the president says. He can't go to a different direction. So tell us here, if you don't have an answer, tell us, we'll call the minister to come and appear before the committee as to when are we going to see the president's commitment going to be implemented without being technical, in simple terms. Thanks. You can actually, okay, the other issue of a retrospective amendment, can you expand this in, explain it maybe in simple terms, put it in writing, that this is a retrospective amendment, effective date, why was it not implemented all along, and why do you want it now? Because we are politicians. We don't only represent government. We represent everybody out there. Even private companies come to us. Anybody out in the public has got an access to members of parliament. So put it in writing and explain in detail what this is all about. Why do you think it is in the public interest to do this? And what is the rationale? So that by the time we have to process these bills or to take them to National Assembly, we will have convinced ourselves that all what you are recommending here is in the best interest of the public. Thank you. Over to you, Treasurer and SARS.
Thank you, Chair. I'll try and have a go again, and then my colleagues can come in. So the provisions of the Act that allow for the rates to be effective in the Income Tax Act, I think it's Section 5(2). My colleagues did what's happening here on this. On the VAT Act, it is Section 7(4), and then in the Customs and Excise Act, it's Section 58. But we can provide more detail if required. On the apologies for not explaining this retrospective amendment clearly enough. So maybe I can start before you even think about the amendment. So at the moment, when you purchase diesel at a petrol station, there is tax that is paid on it. It's about R3 on a general fuel levy, It's just over 2 rand for the road accident fund levy. The general fuel levy revenues that government receives on that diesel, or on petrol in total, petrol and diesel, is about 90 billion per year. About half of that is diesel. So that is paid, and that has been paid for year upon year upon year upon year. So diesel, there has always been this general fuel levy that applies to diesel. What has happened is that there has been an interpretation of the legislation that actually that levy should not have been applied to diesel, and it isn't actually effective. So what this would mean, if that was true, that all the revenues that we have received from diesel, the general fuel levy that is applied to diesel, should not have been incurred. And that means that we would need to pay back to the petroleum resource companies all of the revenue that we got in previous years from the general fuel levy on diesel. And that is clearly not what we want. It would have a very, very large fiscal impact. And that's in effect why these petroleum companies would then get a windfall, because they always assume that this tax would apply. But now, because of this one interpretation of a provision, they are saying actually the tax never applied. So we need to make an adjustment to make sure that the tax does apply and that it did apply for all the previous years. And that's why it needs to be retrospective. But we can provide a written response in case we haven't explained that clearly enough. On the 150% of the 10 million, that's exactly right. So then there would be a 15 million deduction on the corporate income tax that you would need to pay. So if you had a corporate income tax liability of 30 million, you could in effect use that as a deduction to reduce that 30 million by 15 million. So it'll reduce the your taxable income on which corporate income tax is paid by 15 million. We do have some examples, I think, that we can also share on that. The cooperation, I know SARS have been working closely with the FSCA, and I'm sure they can speak to that a little bit more. On grey listing, our colleagues in National Treasury and in the other implementing agencies went to the FATF discussions in Brussels. It was 2 weeks ago. They have presented their progress that they have been making to address the remaining 14 action items that FATF require from us in order for us to get off the grey list. That announcement yet hasn't been made on the decision in the latest joint group meeting and FATF plenary on the progress that we have made, but we have been making very good progress. We would welcome any requests to come and brief the committee on that progress as we continue to try and get off that grey list. On the two-part system, I realized I did also miss a question in the previous round about, well, what was the main aim of the system? So the main aim of the system was twofold. It was to try and enforce more preservation in the system so that individuals then retire with more funds in their retirement funds so that they can retire comfortably. In the system before two parts, whenever you resigned or were retrenched, you could withdraw the full amount of your retirement fund. And that's what the vast majority of people were doing. As soon as they resigned, they would take the full amount of their pension fund or retirement fund or provident fund and then spend it. But then there's very little that's left for retirement. So we, as a country, have seen very, very poor retirement outcomes because individuals don't have enough left at retirement. So we need to try and preserve that amount. And that's what that retirement pot in the two-pot system is about. It's saying you put 2/3 of your contributions into that retirement pot and it must be kept until retirement. The other part was that clearly individuals have been struggling with high debt, high cost of living, and they need assistance. In the old system, this actually led to an incentive for people to resign from their jobs to access those funds. But then that puts them in a worse off position because they no longer have employment. So the savings pot as part of the two-part, was to allow access to part of those funds without having to resign and with no questions asked. You know, there's no conditions there about it has to be an emergency or anything else. You can access those funds. There is a small seeding amount that went in, but going forward, it could be much higher than 30,000 Rand because it'll be 1/3 of all your contributions going forward. And that could grow for the next 2, 3, 4, 5 years. And then if you find yourself in trouble with high debt, you can take out the full amount from the savings pot if you need to. So we will do a lot of work to analyze how the system is progressing. We will continue to consult with labor and business on how it is working and whether it's achieving its objectives. But we're trying to create a balance between preserving funds and allowing access for individuals to get through their daily requirements. Anissa can come in after me on Airbnb and Ubers. On the employment tax incentive, we are trying to, this was a punitive scheme to stop employers who were taking advantage of the youth to then gain an employment tax incentive. In the types of schemes that we see, those youth that we are worried about, they weren't getting any salary from these employees and they weren't getting any job experience. So they weren't getting any benefit. But the employer in these schemes then gets the employment tax incentive. And so the amendment here is to now put a punitive penalty on those employers because they're not creating any benefits for those employees. We want the employment tax incentive to work, but we want it to work in a fashion that does not undermine the prospects for those vulnerable youth, as the honourable members stated. On the electric vehicles, we did consult with the automotive industry. A lot of those consultations were done through the DTIC. That led to the publication of their white paper on electric vehicles. And part of the proposals from the white paper on the electric vehicles was to put in a tax incentive, which is our responsibility rather than DTIC's, to try and assist the industry. The current industry in terms of internal combustion engines does already make use of the APDP system. And that APDP scheme is quite generous and it is not being discontinued. So it will continue to be available for ICE manufacturers. This is an additional incentive on top of it to try and spur on growth in the electric vehicle and hydrogen industry to hopefully transform that sector. On the issue of when is Treasury going to implement this, we need to wait for the minister to make an announcement. The tax announcements are almost always done in the budget of each year. So I would imagine that the minister is going to make an announcement in budget next year on this type of issue. And from then we can then put in the legislation to this committee to implement those proposals from the president. And I think I've mentioned the fuel levy before as well. Anissa, would you like to come in on Airbnb? And then France, I don't know if you've got anything else from SARS's perspective. Thanks.
Thank you, Chris. And thank you for that question on Airbnb as well. I think what I need to highlight on this aspect is that in 2014, we introduced legislation within the VAT Act to tax the digital economy. And in 2019, we expanded the list of services that would, and by implication service providers that would fall within the VAT net in South Africa. And companies such as Airbnb, for example, Uber, all of these would fall within that VAT net since 2019. So that effectively means the way we looked at it in South Africa was that there are two supplies being made in these instances. The one is the international company Uber, I'll take it as an example. I don't want to talk about any specific taxpayer, but I'm just using it as a broad example, is making a supply to the Uber driver. And that supply that it makes is a supply of its platform services. So it says to the driver, you would not necessarily ordinarily be able to attract all of these customers, all of these passengers without the use of our technology. And for that, we are charging you a fee. And that is what they do. They do charge a fee for that. So when you as a rider, you want to get an Uber driver, you go on the app and you book a driver. you then pay on the app directly. But that money does not go into the driver's bank account. It goes into Uber's bank account. What Uber then does is that it sends you an invoice, and then from that invoice, it sends from that transaction, it sends a second invoice to the driver. The invoice to the driver is to extract its service fee for that. So that's a separate charge. The actual passenger transport is a supply that's happening domestically, and that is between the driver and you. Now, in the current VAT legislation, passenger transport as well as domestic accommodation that's not for commercial purposes, for example, a hotel, but normal domestic accommodation, those are now exempt supplies. And, you know, in that instance, we have not looked at taxing that in the hands of the local person, because on the one hand, government speaks about encouraging entrepreneurship and encouraging people to earn an income, you know, that would be, for especially those who are in positions where maybe they are retired and unable to earn, or maybe whatever they're earning is not enough to add to their income. Now, you can't do that on the one hand and then say, well, you know, I'm going to tax you to death on the other hand. But at the same time, we've got to actually look at whether we want to tax these people from an income tax perspective. But from a VAT perspective, thus far, we have not made that decision to tax the local driver or the local supplier of Airbnb. However, the decision was to tax the international company that's coming into our country, earning an income, taking that currency out of the country and not supporting the rest of this country, or not, not paying taxes because they don't have any physical presence here. And that is what was called the digital economy, and that was the worldwide move to tax the digital economy, what was called base erosion and profit shifting, to ensure that companies that do not have a physical presence in your country do not erode your tax base without contributing to the fiscus in any way. So when we expanded the VAT on that, we introduced the regulations on electronic services. And when we expanded that in 2019, it would include the Airbnbs and the international company itself and the Ubers. And they would have an obligation to register for VAT in South Africa, even though they don't have a physical presence here. But they would then have to levy VAT on their charges, which they're charging to the drivers, and pay that over to the fiscus. And whether they have actually done that or not is obviously taxpayer confidential information that is within the purview of SARS. I do know they have a division within SARS that are pursuing companies that are doing such business and that should be registered for VAT in terms of the regulations that qualify for registration and that have not registered as yet. So I know that there's a big drive towards that, and it's been quite successful. I do know that when I've attended meetings at the OECD, and this was prior to COVID, there was an undertaking from the major companies around the world to register. We had done a presentation at the OECD to say that we were introducing this legislation, and there was an undertaking that they would register, they would comply, as they have done in many other countries. So, yeah, I do know from a VAT perspective, we definitely are taxing them, or we should be taxing them. Thanks.
Yeah, thanks, David. Thanks, Anissa. Maybe I can just come in on there as well. So from a VAT, Honorable Makabela, I think it's a very good question, and it's something for us to think about very carefully. From a VAT perspective, it is taxed. If you're an individual who has a house that you're renting out as an Airbnb, the income you make from that should be taxed. If you're an Uber driver and you make a lot more that goes above the income threshold, you will be taxed on that. You should be. The question arises about the companies themselves and the profitability within those companies, and are they taxed? And that was a lot of the Pillar 1 proposals from the OECD to try and see whether those profits should be shared. So for example, if you look at Airbnb, the company, and the profits that it makes, South Africa doesn't have a right on the profits of that company, and SARS colleagues, correct me if I'm wrong. Whereas if you had a competing app like Lekker Slaap, which is a South African app, if they were a South African company, they would be paying tax locally here. So what can you do about that? And this international agreements are to try and fix that issue, but they have stalled in the international arena, and it is something that a lot of countries and us are concerned about. Thank you. France, I don't know, you can also add on that Airbnb and Uber issue if you like. Thanks.
Thanks. It's actually quite surprising, but when I looked at the list of companies registered for VAT before we did the expansion in 2019, in fact, some of the companies that we would think of offhand, and clearly I'm not going to mention names, had already registered for VAT and were paying VAT over. So they were being proactive. They were actually paying us VAT that was not yet something that was enforceable. So I hope that gives a bit of insight as to the degree of voluntary compliance we do see in this space. I mean, I think you make the point very well that there is some difficulty about how you do divide up the taxing rights for these kinds of companies that are customer facing, perhaps digitally enabled, that are in your country but do not necessarily have a presence in your country. And that is a topic that has been a difficult one to address, both at the inclusive framework and I believe even the UN is now sort of weighing in on that. So it's a very hard one, and you can see the issue, because how do you allocate income to the country if there is no physical presence? What are the factors you use? The country that is currently taxing it, they feel, why should they give up their tax base? So there are a lot of moving parts here that make these negotiations extremely difficult. Just coming back to something that I did miss from the first round of questions, which was why do some taxpayers prefer to go to the tax court rather than the tax board? So you remember I drew the analogy with the small claims court. So just as you cannot have a legal practitioner represent you in the small claims court, you represent yourself. That's equally true in the tax board. So if you are being advised by someone, they may prefer to push this up into the tax court so that they can represent you. And if it's a very simple case, the question might be, why do they need to do that? If it's a complex case, then this is the kind of case where SARS would likely say, yes, this makes sense. It does need to go to the tax court, and let's move it up there. And the other aspect that sometimes comes into play is that the person who presides in the tax board, just as in the small claims court, is a qualified independent legal practitioner, whereas the person who presides in the tax court is a judge. And some people prefer to appear before the judge as opposed to the legal practitioner. So that drives some of what we see there. I think we've dealt with that. The question was also raised about the non-compliance and the impact on SARS. So yes, I completely agree. There is an impact on SARS. So if the contributions aren't being made, they're being claimed as a tax deduction. The individual is paying them over and claiming a deduction for them. We're allowing that deduction. The employer is then hanging on to the funds, and then when the employee seeks to withdraw, there is nothing to withdraw. So there are three entities sort of caught up in this. There's us, there's the pension fund, and there's the employee. And then obviously the FSCA comes in as the regulator and needs to look at that as well. Now, I mean, where we can be informed is of the fact that there is non-compliance, and then there are obvious steps SARS can take to pursue the employer, because perhaps these funds have been appropriated for its own account and therefore are taxable in its own hands, because the fact that you've got income that is illegal doesn't stop the fact that it is taxable. So SARS might want to do something along those lines. So there are definitely interactions, and there are information flows, as I explained earlier, between the FSCA and SARS, so that you can take account of the impact the one's work has on the other. But we are not in a position to pursue the employer because of the contravention of the pensions legislation. That is for another regulator to do. But what we can do is tease up the tax implications of what that non-compliance has led to, and then implement those tax consequences. I hope that helps. And I think those were all of my questions as far as I can see. So thank you.
Thank you, Chair.
Thank you. I think we're almost done for now. Honorable Van Rooyen.
Thank you, Chair. Just quickly, I just wanted to check if the committee will buy into my suggestion that we subject these tax bills to the analysis of the Parliamentary Budget Office as soon as possible. And then secondly, you know, Chair, we have been, since our meetings with National Treasury, we kept on being promised information to be shared at a later stage. And I find it difficult because I haven't received anything as promised. But well, I'm subjected to correction. But I will suggest that the secretary must check, because our meetings are recorded, on all the promises of information to be shared after our meetings that has been honored and those that are still outstanding. So as we are able then to be serviced accordingly. Thank you very much.
Thanks, Honorable Van Rooyen. Maute.
Yeah, thank you, Chair. So following up on my previous question about the retrospective amendment, which deals with the fuel products. The reasoning here says that it is done so from the 1st of January 2002, which is the date that the threshold for distillation was introduced. Now, my question is, why did it wait? It had to wait for so long to come. I mean, we're in 2024. So why has it not been effected that time when it happened? And who is responsible for that? Because if we wait for almost 20 years only to pick up something, what more are we missing, which would have been a revenue for this country, which is deferred for another 20 years? So all I'm saying is we've been robbed of 20-year worth of revenue because of this amendment. Now it's coming now into play. So who is responsible for this mess that you are in? I mean, I'm happy that, Chair, we're going to get more money out of this. We're going to tax this fuel companies more because of this amendment, but it's a bit late. And why? And what if some of these companies are now non-existent? They're insolvent now. So we missed out on an opportunity to have taxed them at that time. So it creates a whole lot of mess. But yeah, let's just get to understand why. Is it only coming now? Thank you, Chair.
Thanks, Honorable Maute. And then Snawo's phone. Snawo's phone.
We'll work on that.
Can't rename your phone. Problem?
We'll work on that. It keeps changing back from now tablet to phone. It changes like that.
You are not an old. You are not over to you, Honor.
No, thank you, Chair. I'd like to appreciate the responses from Treasury and SARS. I think they were very helpful, and also appreciate the patience they've displayed. So I think we must, as a committee, and you'll correct me, Chair, if I'm not using the appropriate platform or using this opportunity appropriately. We must, as a committee, schedule a separate sitting, whether special or the Chair will guide me on how these are constructed or constituted, on the matter of the non-compliance with the pension fund contributions as it relates to the Revenue Laws Amendment Bill. I think it requires our specific attention. Of course, there are other processes that we as an organization have embarked on separately with regards to the speaker, but I think we must grant the committee that opportunity and fairness to deliberate on this matter because it affects a multitude of spheres and specters of regulation as has been illustrated here today by Treasury and SARS. So I think as a committee, we must give ourselves the chance to appraise ourselves on the matter, get the necessary briefings from the relevant regulatory authorities, from Treasury, and see what is it as a committee we want to make as a contribution to this discussion before this discussion and the conversation overtakes us, as is already begun to do in the public sphere. So I'm making that submission on us having a sitting on this specific matter in relation to the Revenue Laws Amendment Bill and our strategy with tackling the non-compliance, which affects the effectiveness of this very bill. Possibly this week, possibly next week, whatever the schedule of the committee can determine. Thank you, Chair.
Thank you. In that regard, Honorable Tambo, we had a long discussion some other times when we're doing induction. And what is that adjudicator entity called, which is led by Ms. Lukaimani, has taken us through how they are dealing with defaulters. And last week I saw her on the media dealing with so many municipalities and companies that haven't been contributing the pension that was contributed by workers to the pension fund administrators. So what we will have to do at some stage is to call her back to come and give a scientific report, because we have got an authority that deals with this issue of two-pot system. So we'll find time when we come back after in October. Okay, over to you, National Treasury and SARS, on other questions that were asked by members.
Thank you, Honourable Chair. So I'll engage with the team. We'll send that information that was requested or promised as soon as we can and let you know. On the retrospective amendment on fuel, so how did this happen and why did it have to wait for so long? I can see maybe SARS will want to come in, but I'll give my opinion of it. Is that the industry and Treasury and SARS all thought that the way it was currently being treated was the correct interpretation of the law. So for 22 years, diesel has been taxed, and everybody thought that the law that was in place was sufficient to tax that diesel. What has happened now is that there has been an alternative interpretation of the legislation that was brought up by someone, and they are saying actually it wasn't taxable. So we haven't been robbed of 20 years of revenue. We've received the revenue for 20 years. So, and as part of the fiscal framework, as part of the budget, but now there is an interpretation that says actually you shouldn't have received that revenue, which means that if that is true, we would need to provide refunds for all of those years or for a number of years, which, as you correctly state, would be a mess. So we need to try and fix that. And by doing this retrospective amendment, which we think is sound in law because it is in line with the policy rationale, and it is most definitely a technical error, we think that is fine. And who is responsible for it? Well, I think everybody who was involved in the legislation thought it was applied in the way that or thought it should apply in the way that it was being applied, that diesel was actually taxable. France, do you want to come in and maybe correct me or add to that?
No, I actually think you've got it exactly right. That is the situation. Everybody took the legislation to mean what we thought it meant. And it is only recently that the alternative has been raised. And so, I mean, there are two courses of action here. I mean, SARS can litigate the issue and hopefully prevail. But given the amounts potentially involved here, that is a very, very risky course of action to take. And that's why the retrospective amendment is proposed to place this beyond all doubt and essentially just maintain the status quo. We're not trying to tax anybody more. We're just trying to make sure that everybody is taxed as everyone understood they should be taxed and did understand it for over 20 years. I think that is it in a nutshell. Thanks. Back to you.
Thank you, Chair.
Thank you. The issue of the digital economy, let's continue to engage on this matter. I'm not sure when last were you at Cape Town and OR and King Shaka airports. The Uber operators are more active than the meter taxi, what do you call it? Meter taxis. Here in Cape Town, they even have a very huge site allocated to them by AXA to park as Uber operators. And here is a company called Uber, which is not paying taxes. It's given a very big space. I think it's parking to the one that you turn right when you come out of the there's a bookshop there. I can't remember where it is. You don't turn left when you go to, when you are at Woolworth. The other side, there's a spot called e-hailing. It's just them running that facility. So we pay to sustain AXA. We pay for everything that AXA does, electricity, their land. But people don't come from America and not pay taxes on our land. That can't be allowed. Let's look at this matter. Yesterday, I was reading an article in the Business Day where banks are talking about making a milestone in the digital platform. Why don't we discuss with banks and see what we can do in this regard? Because I hear these stories of OECD and so on, and UN, and they seem not to be interested in this multilateral organization. Or if they are interested, they are moving very slow, or they are afraid of these big companies. Maybe these big companies are owned by big people in the world who are untouchable. For how many years have we been raising this matter? Since I became a member of this committee, we have been raising this matter. And it can't just be like that. Meter taxis keep on complaining to government. You tax us, you do this to us, but you are not doing this to foreign companies who are operating here. Honorable Makubela now raises the issue in the accommodation sector. I did not know about that until today. So how many sectors are going to be affected? And we'll keep on waiting for OECD and UN who are doing nothing. People making lots of money in our country. Because those Uber operators, they charge 25 rand per every 100 rand. That's a lot of money taken out of our country. So let's find a space and discuss this matter and see what we can do. We can't keep being told about other organizations which have got no interest, because those organizations, maybe they serve the interest of America and Europe. It's in their interest to do that. They don't care about developing countries. These Uber are using our infrastructure. Now I got a reminder, for instance, I have to pay for my car at the end of this month. I have to renew the license. And I'm going to do that as a law-abiding citizen. But somebody gets taxi drivers here in our country, operate the Uber and not pay tax. and take 25 rand out of every 100 rand, and we keep quiet. Last time it was Amazon, this time it's Uber, now it's accommodation. The net is growing and the income is massive. So let's deal with this matter and find the solutions as South Africans. We are a sovereign state and we have to take decisions. We understand that we are signatories to conventions and other multilateral agreements that are out there, but they should take into consideration the sovereignty of South Africa. So we'll take the process to the next step of processing these bills, and please provide information on all those areas that have been requested. And when we come back in October, you will have to explain to us as to how are we going to implement the president's statement, because we are dealing with MTBBS. The president made a statement in June, so it's time enough that by October, when the minister tables the MTBBS, this matter of the raised by the president should be attended to. We can't postpone poverty because of being technical, that the time the president raised this matter, maybe we're dealing with other issues. No, when the president speaks, it's a command, hence it's called the commander-in-chief of this country. So when you come back in October, please come back and tell us, this is the president's statement, and this is how we're dealing with this matter. Because when the minister tables the MTBBS, he will also table tax legislations. Thanks very much, honorable members. There are announcements, Alan Tebuko Wutle.
Yeah, they will take over 20 years later, Chair.
Hello?
I'm saying, Chair, if you don't finalize and put pressure, they will tax Uber 20 years later.
No, we will not allow that. They are causing damage to our infrastructure and our revenue. We have to do something. Alan Tebuko, there are announcements. Tomorrow we are dealing with is it the TALAB report? Over to you.
Yes, Chair. Tomorrow is the consideration of the TALAB oversight report. Venue is Committee Room 2, 120 Plain. That's the same venue the committee had day 2 of the induction workshop last month. Thanks, Chair. Starting at 10. Thanks.
Okay. Please distribute the draft report to members in time so that they can study it and make consultations with their parties. Thanks, honorable members. Thanks, SARS, Treasury, support team of SCOF, media, everybody in attendance. The meeting is adjourned. We'll meet again tomorrow, 9 o'clock, to process the TALAB report. Thanks.
10 o'clock. Alan said 10 o'clock.
Alan, is it 10?
Just so that members have enough time in case there's any delays with the buses and stuff like that. So it's 10 o'clock tomorrow.
Oh, okay. Muthu unyaka urobala until uza over late.
No, Mutuma maids, I'm listening attentively, Chair.